Stop before you touch your pension. What I'm about to share could save you from losing a painful amount of money to unexpected tax traps that countless people never see coming. There are pension tax rules so deeply buried in legislation that even experienced financial advisors miss them. And just one of these rules, especially number 7, has disrupted retirement plans for thousands, often without people realizing what caused the damage. Welcome to UK Pension Central, where we break complicated pension rules into simple, clear explanations so you can protect your future with confidence. Today, I'm unveiling 7 pension tax rules that many retirees and soon-to-retire individuals do not know exist. Rules shaped by recent budgets and policy updates. Rules that can shrink your retirement income, reduce what your family inherits, and weaken the financial legacy you've worked decades to build. By the end of this video, you'll know the steps needed to shield yourself from these costly mistakes. Please pay close attention. Missing even one detail can carry serious long-term consequences. Let's begin. Rule 1. Inherited pensions count toward inheritance. Tax from April 2027. For years, pensions left to loved ones stayed outside your estate for inheritance tax. But starting in April 2027, that protection is changing. Right now, if you pass away before 75, your pension can go to your beneficiaries tax-free. If you pass away after 75, they pay income tax on withdrawals, but still no inheritance tax. Under the upcoming rule, pensions will be pulled into your estate for IHT calculations. So if the total value of your home, savings, and pension goes over the £325,000 standard threshold, or £500,000, if your home goes to direct descendants, the amount above that line could face 40% inheritance tax. Example: a £300,000 home plus £50,000 savings plus £200,000 pension becomes a £550,000 estate. That's £50,000 over the threshold, meaning £20,000 in tax, taken away from your children or family. This rule alone reshapes how families pass on wealth. Rule 2. The MPA Trap the Money Purchase annual allowance catches people every single year. As soon as you take any flexible income from your pension, even a small amount, your annual tax relieved contribution limit collapses from £60,000 to £10,000. This happens immediately and permanently. People withdraw £500 or £1,000 for home repairs or a short trip, unaware they've triggered this rule. They continue contributing normally at £20,000 or £30,000 per year, only to face a hefty tax bill later. Even your employer's contributions count toward the limit. Many are caught by this without knowingly doing anything wrong. Rule 3. The state pension and hidden tax codes. Your state pension is taxable, but tax is not taken directly from it. Full new state pension is around £11,500, under the personal allowance of £12,570. But if you have any other income, private pension, rental payments, dividends, or side work, you may exceed the tax-free threshold quickly. When that happens, HMRC adjusts the tax code on your other income sources. This often leads to higher tax taken from private pensions, over or under collection surprise payment demands at year-end. Many retirees are shocked when tax bills arrive, even though they haven't done anything wrong. Rule 4. Pension credit reductions. Pension credit supports low-income pensioners, but for every £1 earned above the threshold, 6p is removed from pension credit. This means someone taking £50 a week from a small private pension might end up losing nearly the same amount in benefits, making them worse off, not better. If pension credit drops, they may also lose council tax support, housing assistance, free TV license over 75s. The thresholds: around £215 a week for single people, around £365 a week for couples. A small decision can have permanent consequences. Rule 5. The tapered annual allowance. High earners or people experiencing one unusually strong financial year can be hit by this rule. If total income passes £200,000, the £60,000 annual allowance begins reducing. Above £260,000, it shrinks by £1 for every £2 of income, down to a minimum of £10,000. This affects doctors, executives, consultants, business owners. Employer contributions can unintentionally push people into tax penalties. Rule 6. Foreign pensions. Many people have worked abroad or receive overseas pension income, depending on tax treaties. Some foreign pensions must be taxed in the UK, some abroad, and some in both. HMRC cross-checks data with foreign tax authorities, so even small pensions must be declared. Failure leads to penalties, interest, and backdated tax. Rule 7. Large withdrawals and high tax bands. This is the rule that shocks people the most. Yes, 25% of your pension is tax-free, but the remaining 75% is taxed as income in the year you take it. Withdraw too much at once, and you may leap into a higher tax bracket. Example, withdraw £100,000 in a single year plus £11,500 state pension. £25,000 is tax-free. £75,000 plus £11,500 becomes taxable income. Income passes £50,270, triggering 40% tax. Total tax bill over £22,000. Spread that same withdrawal across several years, and the tax could drop to £8,000, £10,000, saving over £12,000. Go over £100,000 income, and you begin losing personal allowance, creating a 60% marginal tax rate. Future changes to pension tax relief are also being discussed. What should you do now? Do not panic, but do not ignore these rules. Take action. Review withdrawal plans carefully. Check tax impact before taking lump sums. Avoid triggering the MPAA unintentionally. Declare overseas pensions properly. Prepare for the 2027 inheritance changes. This system is complicated because the rules interact with each other. Avoiding one trap doesn't protect you from the others. That's why UK Pension Central exists, to give you clear, accessible guidance. If this helped you, please like the video and subscribe so you never miss future updates. Your pension is likely one of the most valuable assets you will ever own. Understanding these rules isn't fear, it's protection. It ensures your wealth stays with you and the people you love. Thank you for watching UK Pension Central. Take care and stay financially secure.